All right, let's get right into it. Prestige Consumer Healthcare just dropped their Q1 numbers for fiscal 2026, and wow, did the market have something to say about it? We're going to unpack what went wrong, why it was such a big deal, and what it all means for the stock now.
And here's that reaction I was talking about. A 10% haircut in a single day. Ouch. That's not just a bad day, that is a swift and brutal verdict from Wall Street. This wasn't a little stumble, it was a full-blown faceplant that forced everyone to rethink the entire story.
So here's our game plan. First, we'll rip the Band-Aid off and look at the ugly numbers. Then we'll dig into the why, the big bottleneck with their Clear Eyes brand. After that, we'll check out their big, bold plan to fix it, see how they've had to reset expectations, and then we'll wrap it all up with our final call on the stock.
Okay, let's start with the headline numbers that really set the tone for the day.
And you can see it right here. It was a miss across the board. Now, the earnings miss, okay, that stings. But the real story, the thing that sent up all the red flags, was that revenue number. An $11 million miss? For a company like this that's supposed to be steady as she goes, you just know something deeper is wrong.
So what happened? I mean, where did that $11 million in sales just vanish? It wasn't like people suddenly stopped buying their products. No, the problem was a lot more specific. It was a single critical bottleneck.
Yeah, this was the question on the earnings call. You could practically hear the analysts leaning into their phones. And while management knew there was an issue, you got the sense they were caught a bit flat-footed by just how bad it really was.
And here it is, straight from the CEO's mouth. A planned production shutdown that stretched longer than anticipated. You know, that's corporate speak for, oops, we really messed this one up. This wasn't a demand problem. This was a, we literally couldn't make the stuff problem. A classic supply chain nightmare.
And why did this one brand cause so much damage? Well, look at this. North America is pretty much the whole shebang for them. Over 85% of the business. So when Clear Eyes, a huge brand in that segment, hits a production wall, the whole company sinks with it. The entire North American segment was down nearly 8.5%. Game over for the quarter.
Now, to be fair, management did try to point to some silver linings. And, there were some. Gross margins were up, record cash flow, the international business did well, but let's be real. It's like pointing out the curtains are nice when the house is on fire. Nobody cared about those bright spots when they couldn't get one of their most important products on store shelves.
Okay, so you've got this huge public failure. You've disappointed the market. What do? Well, to their credit, they didn't just say, we promise to do better. They made a big move, a really big bet actually, to make sure this never happens again.
And this was the bombshell on the call. They're buying their supplier, Pillar5 Pharma. It's a classic strategy, right? If you can't rely on them, buy them. They're basically saying, fine, we'll do it ourselves, and taking direct control of their own destiny.
And the logic here is pretty straightforward. Step 1, buy the factory. Step 2, pour money into it, speed up expansion, and get new, faster production lines running. And Step 3, never ever let this supply crisis happen again so they can actually meet demand for this core brand. So how are they paying for it? About $100 million, all with cash they already have on hand. So no new debt, which is good. But check out that point on P&L impact. It's expected to be neutral to earnings. That's key. They're telling you this isn't about juicing profits tomorrow. This is a defensive, strategic move. This is about plugging a massive hole in the boat.
So, of course, a big miss in Q1 and an ongoing supply mess leads to one painful but inevitable outcome. Management had to take a hatchet to their forecast for the rest of the year. And wow, just look at the difference here. They're chopping about $40 million off the top line and taking a quarter out of the earnings per share. But that organic growth number, going from positive territory all the way down to sharply negative, that is a screeching U-turn on the highway, and it's the kind of reversal that absolutely terrifies investors. So what you've got now are two completely different stories being told. On one side, management is saying, hey, trust us, we've got a plan, the core business is strong, the second half of the year will be much better. But on the other side, you've got the market, which is basically screaming, nope, the risk right now is way too high and you've lost our trust. It has become a classic show me, don't tell me situation. Okay, so that's the story of the quarter. Now for the most important part, what happens next? This is where we make our call. Let's talk about the investment thesis, our rating, and a potential trade idea. And this is crucial to understand. This is not a quick fix. Just look at their own timeline. A meaningful recovery doesn't even begin until the back half of the year, and getting back to totally normal could take till next year.
This has absolutely become a prove-it story, and it's going to require a lot of patience.
So if you're watching this stock, what should you be looking for? Here's your checklist. Number 1, does that Pillar 5 deal actually close on time? Number 2, can we see real data showing Clear Eyes is back on the shelves? And the big one, do they have to cut guidance again next quarter? Because if they do, look out below.
And all of that brings us to our final rating. We are calling Prestige Consumer Healthcare an underperform. Look, buying the supplier was the right long-term move, for sure. But the near-term execution risk is just too high. Management has lost credibility, and they have to earn it back step by step. Until we see tangible proof of a turnaround, we think the stock will lag its peers.
So how might you trade that view? Well, here's an idea. A Paris trade. You would short PBH, betting against their company-specific problems. But at the same time, you'd go long a broad consumer staples ETF, like XLP. This isolates the trade. You're no longer betting on the whole sector going down. You're just betting that this one company will do worse than its peers because of its own execution issues.
And our standard but very important reminder, this is not financial advice. This analysis is just for informational purposes. You should always do your own homework before making any investment decisions.